Hello everyone. Now in today's session, continuing with the opportunity, okay, and how to encash these opportunities. That's what we are discussing in these sessions. And today we'll discuss about another very interesting concept as to how to look at these opportunities and how to value them. Okay, so let's start. Very interesting concepts we are going to discuss today. Right. So, what is a superior opportunity? What is the best opportunity that you can get? So, it should have number one, attractiveness. It should be attractive. Attractive in what sense? Attractive in every sense. If you are doing a fashion business, then it should be attractive in fashion sense. If you're doing a fintech business, okay, then it should be attractive in terms of fintech. It should appeal to the relevant people out there. Okay. And though when we talk about opportunities, normally we tend to speak from business point of view, but that is not necessary. So when we talk about opportunities, it is equally relevant for employees out there, okay, in terms of the employment sector. So you have to take it according to your interest. If you're interested in taking up employment, then you have to take opportunities in terms of employment, right? Great. So you take all these things that I'm going to tell you today in your perspective. So it should be attractive, number one. Number two, it should be durable. Durable means it should have a length. If there is an opportunity which is only for the time being, say only for 2 months, like suppose India is going to organize an Olympic Games, okay? So an Olympic Games will be held over a period of say 20-25 days, and the preparation will take another say 4 to 5 years before that. So it's a good opportunity because when you are talking about participating, I'm not talking about being a sportsman, right? I'm talking about from say preparing infrastructure. You get an order from the government for constructing a stadium. That's a good opportunity. But then if you invest too much into, setting up resources, setting up a whole company for just making one stadium, and then what? Then what? So if there is no continuation of opportunities, no recurring opportunities, then it's not worth doing it. So a lot of companies have gone into losses even after doing big projects because there is no continuation of those projects, right? So as I was saying that you have to take it in your perspective. So if I'm looking from employee point of view, an employee perspective, then I would join such a company which has a very long term objective. And I'll not join a company as an employee which has a short term objective. Okay. So, therefore, when I talk about opportunities, it is equally relevant for both the business class as well as the employee class. Okay. So, when you talk from employee's perspective, you look at a company which is searching for a bigger opportunity because and this is one mistake that employees normally do. You don't look at the company as a whole and what is the business of the company, what is the strength of the company, what are the values of the company, where the company is going, what are your objectives in mind. You don't look at that. You just look at the job, that okay, this job opening is there, so let's go and apply for it. That's not good, because if the company shuts down or if the company doesn't progress, then you also will not progress. Okay, so your progression inside the company depends upon the progression of the company itself. So always look at the company, evaluate the company first, evaluate the opportunities that the company is running after, and then you see your positioning vis-a-vis the company's positioning in the business. Okay, that's very crucial. Okay, so first point is opportunity should be attractive, it should be durable. Or let's take another example from employee's perspective. I am looking at, say, doing a course in artificial intelligence. These days, everyone is doing artificial intelligence, right? So I'm also doing a course, for example, though I'm not doing personally. Just an example, I'm doing it, or I think of doing it. So should I do it? Should I take that opportunity in artificial intelligence? Should you take one? What is your perspective on this? Okay, what is your perspective? Would you take something in artificial intelligence? Look for a job in artificial intelligence? Yes, you should, and I should, because it has a very long term perspective and it is very attractive as well. Every field today, whether it is medicine or accountancy or any, you talk about anything, space research, uh, cars being built on artificial intelligence. So AI is something which is pervasive. It is applicable everywhere. It is very attractive. A lot of people are running after it. Everyone wants it. So it is highly attractive. Number two, it is very durable. The length over which artificial intelligence will continue to rule the market is tremendous. I can't see an end right now. So the wave is quite big, you know. So it serves both the purposes. So that is how you have to evaluate an opportunity. So even as an employee, whether to enter into a specific field of AI, should I go for it? Yes. Should you go for data analytics and data engineering? Yes. Because these are the fields which have a long life. Okay. So you'll not be outdated very soon. And the third thing is timely. So, we have talked about the wave concept. So it is quite similar to this. The wave begins and it ends, and you have to enter at the right time if you want to go far, right? So this is another way of putting the same thing, that it should be attractive, it should be durable, and it should be timely. If you enter a space before its time has come, or you enter it after the time is gone, then you are not there. You will not get the diamonds. You'll not. So therefore, it says there's an old adage, English adage, that uh, the early bird gets all the worms. Yeah. So here, early doesn't mean getting up at 5 a.m. or 6 a.m. or 5:30. It is about the right timing vis-a-vis the opportunity, and is anchored in a product or a service. So there are two things we should look at: the opportunity, which has three characteristics: that it is attractive, it should be durable, means you should have a longer period, and it should be timely, means it should be at the right time. Okay, at the right time, at the right place. And it can be a product or it can be a service. The opportunity can be a product, opportunity can be a service. It can be both, either or. That creates value. Now, the very important definition: it creates a value for the buyer or the end user. It should have a value. If it doesn't create a value for the buyer, then that opportunity has no value itself. So the value of opportunity comes from the value that it is going to provide to the end user. Okay. Now, when we talk from startup perspective, if you guys are interested in running a startup sooner or later, as the case may be, or venturing out into a business, you have to value the opportunity. So how do you value an opportunity? Depending upon who will be the prospective buyers or the end users of your product. Okay, so right now, as I am developing, we at Talent Place are developing a technology for HR, human resource, and this is going to be available to all the employees out there. You can come on our platform and make your CVs, make your resumes, very attractive resumes, okay, and in-depth resumes. So who is the client for me? All the employees. How many employees are out there in the world? Billions. So that is the big market that we have. So you have to evaluate the market. What is the market for my product? Okay, so that's called as the total addressable market. We call it as TAM, total addressable market. But are we able to reach everyone out there in the world today? Probably not. So we'll be starting with India and US. Okay, so what is the crowd in India and US which can probably use my platform? That becomes serviceable market. So there's a total market. Out of total, there will be a certain sector to whom you can service. That is called as a serviceable market. And within that serviceable market, there will be a small portion which we can really obtain today. Okay, we can hit and they can adopt our product. They can start using the product. So that is how you have to evaluate the opportunity that you have. So an opportunity may be very big, like artificial intelligence is a very huge opportunity out there. But what are you going to do and how you are going to capture a subset of the whole market? Or as an employee, what you are going to do, which company you are going to join, and what purpose you are going to solve, that will create a value for you. Okay, so employees make second biggest mistake. They think that they are just working, they provide work to the company and they get paid for it. If you think so, you will end up doing so. Now change your perspective in life. Don't think that you are providing a service. Think that you are providing a value addition to the company. You have a certain knowledge base and you are providing that knowledge base to the company, and you are getting paid for that knowledge base, not for your service, not for your time. So once you think like that, you know, you will value your own knowledge base. What is the kind of knowledge that you are providing to the company? What is its market value? You should know about it. You should know the market value. And then, if you know the market value, you will be in a better position to demand your salary from your employer, right? So that's how you have to value yourself. So going ahead, unless you know what value I'm providing to the people out there, I will not, encash any opportunity in life, whether in business or in employment. So understood, this is the definition of an opportunity given by a very famous author, Jeffrey Timmons. So let's discuss these three things in detail. One is it should be attractive. So opportunity must attract people who will execute on it and the stakeholders who will support it. So one is the buyer who will use my products. Second is the stakeholders. Stakeholders means the investors, for example. People who will invest in my company, people who will supply technology to my company, people who will associate with my company, okay, in different categories. So it should appeal to them as well, not just the public out there, not just the users, but also the stakeholders. The stakeholders want to see robust market, margins, and money making capability. Now, this is the important one. So, attractiveness in what sense? So, when an investor comes to me and says, okay, Farooq, what you're doing, I explain to them, okay, I am doing this business. He says that, okay, what are the amount you are charging from the customers? Is it good enough? Is there a robust market? Number one, how many buyers will take your product? What is your margin? Margin means the gross profit that we are going to generate. Say, for example, I'm spending money to acquire the customers, right? I'll have to advertise for my products and all and attract customers. So if I'm spending, say, 300 rupees to acquire a customer, and then I provide service to him and I charge, say, 600 rupees. So there is a margin of 300. Cost is 300, 600 is the price. So the balance of 300 is the margin that I am earning. So that's good enough. But if my customer acquisition cost is higher than the sale price, then I am losing money. And startups do lose money in the initial stages. Their cost of acquisition is higher as compared to the revenue that they will generate, because in the initial stages they have to invest a lot in customer acquisition. And over the life of a customer, the customer acquisition cost diminishes and the revenue increases. They will use more of my products and therefore the revenue will keep increasing and the customer acquisition cost will keep decreasing. So the margin will increase over time. So I'll have to prove this to the investors. Okay, otherwise he will not invest in my company. And the money making capability. Is your business good enough to make money over time? Okay, so these are the things that the investors will look for. what we normally call as the risk reward balance. Second point is durable. So durable means it should have a relevant window. Every opportunity has a window, like a wave. It comes, it peaks, and it falls down. So you have to earn money during this window. Okay. And the window should be good enough. The window depends upon the business to business. So a window of 3 months is good enough for, say, Diwali sale. So people earn a lot of money during Diwali. That pataka business, crackers, firecrackers. The window is very small. Every year it comes for, say, 2 months, but they make good money out of it. It's a good opportunity. So then it's good for that. But say if you are developing a big size company just to make one stadium and then there are no other orders, then that's not a good opportunity. Okay. So it should have a long enough window. For startups, normally we take it from 4 to 10 years, okay, during which you will earn money and the investors can also make money out of it. And durable opportunities don't disappear overnight because they are difficult to capture. Now, this is a very important point. This is a very crucial and important point, even for employees. Are you providing a value which is difficult to duplicate? Okay, this is a very crucial point for success and big success. If you're providing something which can be easily replicated, anyone can come tomorrow and replicate your idea. There is nothing great in it. It is easily replaceable or somebody can replicate it. Then that's not a good opportunity because you will invest heavily in building a business and then somebody would come and eat up your business very easily. So that's not a good opportunity. Okay. So it should be difficult to capture. If it's difficult to capture for you, then obviously your competitors will also face that difficulty, and the third person and the fourth person who comes should also face that difficulty. So they will not be able to catch up with you so easily. That's very crucial. And uh, uh, Byju's, you must have heard about the name Byju's. It's into edutech, and I was also in edutech, so I know. Though I'm not saying anything against them or their business model, but I personally, it's my personal view, don't think it's based on a very good business idea because it is easily replaceable. Now, unless they invest heavily into technology and develop a kind of education, develop technology, so in-depth technology that number one, it is not easily replaceable. Somebody, the competitor will have to invest billions and billions to develop the same kind of technology, like what Google has done. Tomorrow, if you think you can build a Google, it's not possible. You'll have to invest heavily and you don't have that money. So competition is avoided. So this is very crucial point. Okay. There should be difficult to capture that opportunity. So then it makes it durable. And the third thing is timely, of course. So catch the wave at the right time. This is, I've been telling you from a long time now. And many people fail as they pursue something either too late. Like today, if you talk about building a web browser, you are already very late. Please don't do it. You will fail miserably. Or a freelancing platform, there are thousands out there. Or too early. If you're too early into something, like there's an example of Evan Williams given there, he started a podcast platform before he started Twitter and he failed. So, because when he started his podcast, it was not in vogue. Nobody knew what was podcast. So, he was too early with that idea. So, he failed. But today, everyone is doing podcast. Even I am going to start podcast very soon. Okay. So, podcast is in vogue today and everyone knows about it. So, it's easy to enter and there is a huge market for podcasts out there. It is growing much at a fastest pace as compared to video market. So video market has seen the peak. YouTube and TikTok was there, and so many other video platforms were there. So they have seen the peak. But podcast is a new entrant and it is rising at a much faster pace. So it is today, But when even Williams started it years back, it was something very new. Nobody knew about it, and therefore he failed in that venture. So it should be timely. And it should add value to the buyer or the end user. This is very important. So most startups fail because they fail to close the gap between the product offering and the customer needs. So this is again a very important point. A gap between the product, what you are offering, and what the customer needs. The value is created because of customer need. If customer doesn't need it today, then the value is not there. So the idea doesn't need to be good enough. It needs to capture the customer needs. That's the crucial point. So for employees, the customer means your employer. If he needs some kind of technology, some kind of value addition, and you are able to provide it, then you can demand your price. So then what is the best approach forward? How will you do it? So here I'll explain there are two kinds of thought process. Okay. And to understand this is very crucial today for you. You never know when you will use this in your life, but at least you have the knowledge of it. Once you have the knowledge, you can use it at any given point of time. So there are two approaches of going forward. You know, one is the old approach, the traditional approach, which is called as the causality approach. The cause, okay, based upon the cause. So what that approach says that you define the end first. Like we'll say that, okay, I want to do that business. Or what we normally do in education, let's we decided that we have to do chartered accountancy or maybe engineering or whatever. So you decide that, you decide the end first. And then you build the path. Okay. So you make strategies to accomplish that goal. And though there's nothing wrong with this idea of doing things, but it is an old-fashioned way of doing things. Okay. So in this approach, what happens is that you predict the future first. There is a prediction involved that what will be the customer needs 10 years from now? What will be the customer needs 5 years from now? What will be the demand in the industry so and so years from now? So you predict the future. And you know, it's how difficult it is to predict the future, but you do it. Okay. And then you navigate towards it. Means you make all the strategies to accomplish your goal. Okay. So you start with the end in mind and then figure out the means to achieve the end. So this is how the normal business models happen. But the second method, which is what startups follow, is called as the effectuation, the effect model. Now, here what happens is that they believe that you cannot predict the future. Now, if I have some idea, it may be a very good idea. I know that people will need this, but I'm not sure about it. I cannot predict that how many people will buy my product. Okay. But yes, I have some idea, some vague future prediction. I mean, it's vague. It cannot be identified. It cannot be fructified. Okay. I cannot measure it right now, but it is there. So what I do is I start and then I am ready to change and navigate as I move forward. So it is like river rafting. Have you ever done river rafting? No? It's a very good sport and a very thrilling sport, and I really enjoy it. I have done it many times in a lot of countries. So what you do is you just put your boat, in the waters, and the waters are turbulent. The river is turbulent. It is falling down the hills. So you just throw the boat in the water and you jump in that boat and let's move forward with the water. Let's see the flow and we'll navigate our way through as we move ahead. If we need to make some changes, we are ready for it. And as we move ahead, we may find a lot of opportunities coming up here and there, and we'll navigate here and there and take those opportunities. And in 5 years, we'll probably do something which we had never thought of when we started. And that's precisely what I'm going through in my startup right now. So when I started 2 years back, It was a totally different idea. But going through, as we talk with customers, as we talk with companies, as we talk with a lot of people in the right places, we get a lot of new ideas, a lot of new things come up. And then you manage those things, you move forward, you keep changing yourselves, and that's how you move ahead. So that is called as the effectuation method, and this is something that you guys need to learn. Please mute yourselves, everyone. Okay, right? So let's see what it says. So in this method, you take stock of the means, how you start. Now, the important point is how will you start? So you first see what you have, the means today. Now, this approach has to be applied in different ways. Like for business sake, I will say, okay, what do I have today? So I have say $50 million with me. This is just an example, okay? So I'll say I have $50 million. For an employee to take this method of opportunity, he'll say that, okay, I am an engineer, I am a chartered accountant, I have this degree, I have this knowledge, I have this certification. Okay, so what you have today means. Okay, so what is this? Take stock of your means. Envision a future filled with various possible ends. So don't close down on one end, don't close down on one goal. Keep it open, keep the end open. You may reach somewhere. So we'll start today. We'll just see, what do I have today? What do I have today? So I have these degrees, I have this money, I have this, I have this, I have this. These are my strengths, as we have done in our SWOT analysis. Okay. So concentrate, focus on your strengths. Given what I'm facing, so this is the approach. Given what I'm facing and what I have, what is my next best step towards achieving my goals? So think forward, don't look backwards. So we'll not fix a goal and then see backwards. Rather, we'll see what we have today, what is my strength, and what should be my next best step. That is the crucial point. So the whole thought process is reversed. So there are 4 principles that you have to keep in mind. First is the bird in hand. Take stock of your strengths and advantages, the resources that you have today. It can be advantage as well, like you are in an advantageous position. You are, say, having a location advantage, or you may be having some other advantage. You may be in the right spot. You may have some licenses with you, which allows you to do certain businesses which others can't, because they don't have those licenses. So that's very important. Then use them to create solutions. So you have taken the stock of your plus points. Now you see what I can do to achieve this, how I can use my plus points to achieve something. Don't wait for perfect market conditions. Don't wait for market conditions. You just employ your resources and start doing things. That is the first principle. The second is the lemonade principle. There is a saying that you only have lemons. That's a negative statement. Like people would say that, okay, you are not good enough, you only have lemons. I say, okay, if I have lemons, I can make a lemonade. Means, considering what I have, it may not be a very great thing, but still, whatever I have, what is the best thing I can do? So if I'm not a chartered accountant, if I'm not an engineer, but yes, I can make pani puris, I know how to, make pani puris, then why not start a pani puri stall? And who knows, tomorrow I can be a billionaire selling pani puris. And yes, I'm not joking. Few days back, I read an article in Times of India about a person who has started selling charts in US. Now just think about it. Chart, which is available in India on every nook and corner, right? On those thelas. So this guy, started a chart selling restaurant in US, And very soon, within a few years, he has become a billionaire. He's the most sought after, restaurant in entire US. Now just think about it. Selling charts. So he has no degree. He might be having some degree, but he has not used that degree. What he's using is chart. So that's how you become a billionaire. That's how you achieve success. Okay. So think of what you have. What is your plus point? And start doing it. So expect surprises, because when you start something, you will have a lot of realizations. The real realizations come only when you start something. So start it. You'll have a lot of surprises. Be ready for it. Positive and negative surprises both will hit you. Be ready for it. Be ready to face them. Okay. Remain flexible and look for opportunities. Make lemonade from lemons. If you have lemons, make lemonade. So that's the second point. The third is the crazy quilt. Negotiate with stakeholders. Stakeholders means people who will associate in your business, maybe your investors, who are willing to make commitments without worrying about opportunity cost. Find investors. Don't find investors who look at the end goal. Find investors who believe in you and your ability to do that thing. Okay? And they're not worried about the opportunity cost. Enter into new partnerships. Enter into new partnerships that can bring new funds and opportunities. Okay. Now, these partnerships are also very important. Choose people correctly. People who believe in you, people who will contribute even in terms of opportunities. So you be open, you are ready, because you don't have an end goal in mind. You are open for opportunities. So when you talk with these partnerships, okay, what we can do next? Tell me. I am ready for it. If you tell me that this is a good opportunity, I can conceive an idea around it, and we can do that. We can do this. We can do this. I'm open to everything. So that openness is very important in this approach. This is a very unique and very interesting approach. Open-minded approach. And the last one is affordable loss. So this is now very important. Since you have taken stock of your resources, you also take stock of your money resource. Then how much money I have? How much can I afford to lose? Okay. Normally what happens is that when you talk of business, the approach is that, okay, how much revenue can be generated? How much revenue can be generated? That's the first question we see. How much revenue can be generated from this business, and how much investment is needed? So revenue comes first, investment comes later. Now in this approach, it is a reverse approach. You just put your stake. Okay, I can put in $20 million in this business. I can afford to lose $20 million. If that's too much for us, then okay, let's speak sense. Okay, I can invest 2 lakh rupees and I can afford to lose it. Even if I lost it completely, it's fine with me. So that's the starting point here. Okay, how much you can afford to lose? Define it, and don't go beyond it. Once you have lost it, forget it. Now put some money into some other idea. Then don't look at the outcomes and determine what is worth risking. Calculate your risk and decide what you are willing to lose to follow a course of action. So calculate the risks and decide in the first instance itself that this is my maximum limit up till which I can lose. Okay, then I have to pivot. In fact, if you have put say $1 million on the table, don't put full 1 million in one single goal. Okay, so you start somewhere. So put limits out there, say 10%. So if you lose 10% in pursuing one idea, then there is a time to change. So think of something new, divert yourself, pivot. So pivot yourself, do something else, lose another 10%, then pivot somewhere else, lose another 10%. So by the time you have lost say 50-60% of your total money, you would find the right spot, the right opportunity, and then you will start earning also. So that's how you will minimize your risk. So the fundamental mind shift is needed for this. Okay. So you have to shift your fundamental thinking process to optionality. So this is about options. You always have options open with you. Don't commit yourself just to one thing, that okay, I'll do this or I'll die. No, this is not about do and die approach. This is about doing it, learning it, changing yourself, doing something new. So rather than maximizing returns by selecting optimal strategies, determine what you have and what you are willing to lose. Look at your options and choose the one that provides more options. So out of say 10 options, I'll choose one which has more options within it. It should be broad ended, not a close ended option. Because close ended option will make me, hit the end at a particular point of time. That's not good. So choose something which has more options in there in the future. You can pivot more and more. And build the venture to attract stakeholders and uncover additional resources and more options. So start with what you have, risk what you can afford. Don't take loans and risk. Risk what you can afford out of your own saved money. Be open to pleasant surprises as well as the unpleasant ones. You have to learn from them. And look for relationships with others. Don't try to predict the future. Don't try to predict. Take it as it comes. Okay? The time is now. The future is unmade. Somebody has rightly said, you cannot predict the future because the future has not come. It is unmade. So you cannot predict something which is unmade. You have to navigate yourself. You have to build your future. You cannot predict future. You have to build it. Ford, who built the Ford Motors, Henry Ford, somebody asked him later on when he became very successful that why didn't you ask the consumers what they want? He said that I built the first motor car. If I had asked the consumers, the customers, before building it, they would have said, we want faster horses. But I was not building faster horses. I was building something which was absolutely unique. So who would have predicted the future? Nobody. He made it. And that's the important point. You make the future. Somebody who invented artificial intelligence, nobody wanted it. He invented it. And now everyone is using it. When I started my video classes way back in 2012, nobody wanted it. No CA student ever demanded from me that, sir, please provide us with a video lecture. No one did. I recorded it. I made them listen to it and watch it, and they asked for more. That's how you have to invent. Okay? You don't know the possible outcomes. So that's the story of it. So this is the approach that you have to follow in life in order to be very successful. Don't go by the traditional approach. Traditional approach is old. Forget it. Now you have to. So this is the repeat. So that's the story for the day. Start fresh. See what you have. Define a line of the loss that you can sustain, what you can afford, and what you can sustain, and just start doing it. Take the first step and the next step. Fail fast, learn fast, build fast. That's the story.